Hi, everyone. I'm Mark Lichtenfeld, Chief Income Strategist with the Oxford Club. This is my new State of the Market video, and this is my new haircut. No more flowing quarantine locks. Sorry, ladies. All right, enough about my hair. Let's talk bonds. Last week when we discussed bonds, we talked about why you should consider adding them to your portfolio. Today, I'm going to talk about how to actually buy them because it's not quite as simple as buying a stock. When you buy or sell a stock, you go on your broker's website, you get a quote for the stock that you want to trade, and you pretty much just click buy or sell, and you put in a market price or a limit price, and you wait for your order to get filled. Easy peasy lemon squeezy. With a bond, it's a little bit different. The price is not as transparent with a stock because unless it's a brand new bond, the price is going to be different depending on where you look or which broker you even talk to. Now, you heard me right. If you look up the price of a stock, it will be the same on E-Trade, Ameritrade, Morgan Stanley, wherever you look at it. With a bond, the price might be different for each broker, and that's because it depends on if they have the bond in their inventory, if they are marking up the price, which they are allowed to do, and they often do, if they have to go out into the marketplace to find the bond for you. And there's no one single exchange for a bond like there is for a stock. Now, sometimes your broker's website will have the bond that you're looking for to trade, and you just click buy or sell, just like you would with a stock. But other times you have to call the broker and ask them to what's called work the order for you. Go out into the market, find the bond, negotiate the price for you, and you'll pay for that. With a brand new bond, you won't have to pay anything, but for an existing bond, trading in what's called the secondary market. If you're just buying it online, you may pay, let's say, $1 a bond. But if you talk to a broker, it could be as much as $10 or even more per bond. So be sure you're clear about what the fees and commissions are and what you're getting for your money. Discount brokers will simply conduct the transaction for you, while a full service broker, which costs more, will also be keeping track of your portfolio. They may call you with interesting opportunities you may not have heard otherwise. So just make sure you know what you're paying for. Now, when you buy a bond, there's some information you need to know. Bonds are sold in increments of $1,000, and when they mature, you get your $1,000 back. But that doesn't mean they all cost $1,000. Once they begin trading, just like a stock, they go higher or lower. So you could pay $900 for a bond that pays $1,000 when it matures, or you could pay $1,050 for a bond that pays $1,000 when it matures. Now, why would you pay $1,050 for a bond that will pay you $1,000 at maturity? Well, let's say you're getting paid 7% interest for the next 4 or 5 years. Would that be worth losing $50 at maturity? For some people, it would. Now, even though bonds are sold in increments of $1,000, chop a zero off when you're talking about the price of a bond. A bond that's worth $1,000, also known as par value, trades at $100. Now, don't get confused. You still need $1,000 to buy the bond, but the price is listed as $100. A bond that is priced at $88.75 actually costs $887.50. Now, another concept to understand is the maturity. The maturity date is a very important factor. The date that a bond matures is the date that you get paid your $1,000 back. Now, some investors don't want to lock up their money for, let's say, more than 1 to 3 years. Other investors are perfectly fine with locking up their money for 8 years, 10 years, or even more. The coupon rate, that is the rate of interest that you'll get paid. It's based on the par value of $1,000. So a bond with a 5% coupon pays $50 per year, usually in 2 installments of $25 every 6 months. But remember that 5% is based on the par value of $1,000. If you bought the bond for $900, you would actually earn 5.6% because 50 divided by 900 is 0.056 or 5.6%. If you bought the bond for $1,050, then your actual yield would be 4.8%. Now, these have all been pretty easy to understand. The next one's a little bit trickier, but it's really important. It's called yield to maturity. Now, this is basically the annualized yield that you'll receive over the entire investment at maturity and taking into account any gain or loss on the bond. So remember, if you bought the bond for $900, you have a $100 gain at maturity. And if you bought for $1,050, you'd have a $50 loss. So those gains and losses are taken into account when you're talking about yield to maturity. So you could have a bond with a 5% coupon, but because you bought it at a discount, your yield to maturity is 7%. So that means that at maturity, your bond earned you an average annual rate of 7%. Now, the last thing to be aware of is a bond's rating. Now, there are various credit rating agencies that rate the bonds, and the highest rating is typically AAA, which is the safest, and the lowest is D, which means the bond is in default and is no longer paying interest to the bondholders. Really important to understand that because a bond is rated high, it doesn't guarantee its safety. Now, remember, these rating agencies are the same clowns that rated the mortgage-backed securities very high, very safe back during the financial crisis in 2007, 2008. And we know how that worked out. But generally speaking, the higher the rating, the safer the bond should be. Thanks for watching State of the Market. I'll be back next week with another video. In the meantime, please check out my free newsletter, Wealthy Retirement. Every day we have brand new content on all kinds of investing topics, including how to compound and build your wealth. So check it out by clicking on the link. I'll see you next week. I'm Mark Lichtenfeld.